Well, the Fed has now cut interest rates for the first time in quite a long time. And this brings us new questions. What's the path moving forward? We have to look at the bond market reaction. It's very telling. And by the way, within the bond market, there is a cause for concern. And also, we want to know, will housing prices decline? When will that happen? First off, let's talk about the US Treasury market. We can see here the 2-year bond pays at 364, 10-year 372. We no longer have an inverted bond market condition. Longer term yields pay more than short term. We can take a look at the 10-year in blue, 2-year in red, and over the past couple days, we've seen an increase in the bond market. Both yields are moving higher. The 10 seems to be moving higher faster than the 2-year. Now, what does that mean? We're going to show you in just a moment, but it's opposite of what was happening at the time in 2007. Notice in blue, that's the 2-year. In red, the 10-year. S&P 500 is in gray. And what we can see is as the inverted bond market ended, the 2-year and 10-year were heading lower. Remember, we just saw both yields are moving higher. Now, there's an important distinction. Short-term maturities like the 2-year, they tend to move most closely with interest rate decisions. When the Fed cuts rates, short-term yields go down quickly. 10-year, long-term maturities tend to move under the prospect of economic conditions over the long term. So in 2007, both lines were going down because the Federal Reserve was anticipated to cut rates, and at the same time, the economy was really starting to fall apart. We're seeing the opposite, at least over the past couple days, as yields are rising. What does that mean? Well, there could be a cause for concern. Divergence becomes convergence. We see here in red, S&P 500. In white, that's the 10-2 spread. Now remember, that's the 10-year yield minus the 2-year. It's a difference between the two. The white line is going up because the 10-year is going up, relatively speaking, more than the 2-year. The inverted bond market ended. But what we can see is historically we had divergence. Divergence is disagreement. Stocks go up, the 10-2 spread goes down. Stocks go up when the long-term prospects, meaning the 10-year yield goes down, and that's anticipating, hey, the economy doesn't look so good, the Federal Reserve is going to cut interest rates. And we can see the opposite takes place as well. When the stock market goes down, the 10-2 spread increases. When the 10-2 spread increases, it looks like the economy is strong. The Fed may have to, raise interest rates or keep rates higher. But what's happening now is very interesting. Stocks are flirting very closely with all-time highs while the 10-2 spread increases. So what's happening here? The prospect of the economy strengthening over the long term reflected in the 10-year bond going up, yet the Federal Reserve is cutting rates. When divergence becomes convergence, when the market trend changes, the dynamic changes, we should be very careful because sometimes this is the beginning of a new trend. Does this mean that the stock market is going to go down now, or is that the dynamic with the bond market is going to change? Now, the big question is, when will housing prices decline? It's popular thought that, okay, the Federal Reserve is now on the path to cut interest rates. And a lot of homeowners that were locked in with these low rates have not sold because they don't want to exchange a low interest rate mortgage for a high interest rate. But now the mortgage rates are coming down so aggressively and the Federal Reserve is now cutting rates, maybe they will now choose to sell their house. More supply. Does this mean housing prices will go down? Well, let's move backwards. First of all, what our question: when will housing prices decline? Well, in order to answer that, first we need to see the mortgage rates decline. Remember, everybody locked in at a 1 or 2% mortgage doesn't want to sell until they have a chance to roll over into a new mortgage that's not significantly higher. So we have to wait for mortgage rates to decline. But before that, we need the expectation the Federal Reserve is going to cut rates. They did today, but continue to cut rates. The mortgage rates loosely follow the Federal Reserve activity. But what we spoke about yesterday, and we're going to talk about it again, it's actually a very interesting dynamic. The mortgage rates sometimes overshoot actual Fed decisions, and it can be used as an indicator. But we need to see the expectation that the Federal Reserve is going to continue to cut rates. What will facilitate that? Job market declines. The Federal Reserve wants to cut rates if inflation remains steady, but the jobs market really starts to fall apart. That's what their major concern is. The conference today was actually quite telling. They spoke a lot about the jobs market. Well, what's involved in the jobs market? And these are the things that they spoke about in the conference: labor force participation rates, non-farm payroll, the JOLTS, the job opening survey, and the unemployment rates. Let's take a quick survey to look at what the jobs market looks like right now. Labor force participation rate, that looks pretty good, 62.7%. Not bad at all. We take a look at non-farm payroll, not so good. It's 142,000 jobs were created last month. The month prior, actually the 2 months prior, they were revised down. Actually, quite a few prior non-farm payroll reports have been revised down. And we've spoken about the non-farm payroll historically. When we're looking at numbers, 100,000, a little bit more, a little bit less, those are not good non-farm payroll numbers. We want to see the NFP in the twos, even approaching 300,000. How about the job openings according to the JOLT survey? Not good at all. This is reported in thousands, and we can see we're at the lowest low we've seen in several years now. And the unemployment rate, we know, is at 4.2%, just a tick below last month's 4.3, which did trigger the SAM rule. But the unemployment rate on the rise certainly is a cause for concern. So we see 3 out of 4 of the indicators in terms of the jobs market, it looks neutral to maybe negative. Labor force participation rate probably looks best out of all of these indicators. Of course, there's nuances, but understand, and we're going to continue to watch these 4 indicators very closely in the time to come. If we start to see these move to the downside, that will trigger the expectation that the Fed is going to have to be more aggressive to cut rates. That expectation will lead to lower mortgage rates, which in turn could lead to more selling in the housing market, just to close that circle. Now, speaking of mortgage rates, we spoke about this yesterday, but it's a topic that really deserves to be discussed a lot more. It's very relevant. In gray, 30-year average mortgage. In orange over here, those are the Fed funds. And what you'll notice just before, this is 2008, by the way, just before the first Fed cut in 2008, actually about a couple months before, we saw mortgage rates decline from 673 to 631. See, mortgage rates aren't tied to Fed funds. Mortgage rates are tied to the mortgage market. The mortgage market was expecting the Federal Reserve to cut rates. So mortgage rates declined ahead of the Fed action. So we can actually use the mortgage rates to forecast perhaps if the Federal Reserve is going to continue to cut rates. Notice what happened afterwards. And remember the context, late 07, early 08, when stocks really started to go down, the mortgage rates continue to drop from 631 mid 07, late 07 to December, January 08, we had mortgage rates at 548. So what's the lesson? What's the takeaway? Mortgage rates continued to decline with the expectation the Federal Reserve would continue to cut rates, which they were right in doing so. If we see, on the other hand, mortgage rates from present day moving forward start to rise, maybe it means that the Federal Reserve overshot their goal in the near term, meaning that, okay, they cut by 50 basis points. Maybe that was too much. Maybe, we don't have to be so aggressive moving forward. So we're going to watch and we're going to report on mortgage rates. It could be very telling for what's to come. We hope this has been helpful. We look forward to seeing you back soon.